Good afternoon. I want to welcome everybody to today's event, Top 10 Stock Picks Sneak Preview. It's Monday, August 8th. Got John Hopkins here and Tom Bowley going to jump in a quick minute. Hey, if you happen to be new to the Earnings Beats community, I want to welcome you. Great to have you check us out here. It's going to be a good one, I think. Of course, our seasoned veterans, thanks so much for supporting us like you have. Some of you for many years. First started the company back in 2004. And so we've been around a while. Anyways, tonight's recording will be recorded. For some reason, you're not able to stick around for the entire event, no sweat. And if you end up becoming a subscribing member, you can take out a free trial, 30 days for nothing. You'll be getting full access to all of our webinar educational archives, and there's a lot of great stuff in there. The event tonight is really a setup for an event that'll take next week when Tom unveils the top 10 stock picks in the portfolios that he has assembled. That will be a members only event. Today's open to the community, free event, but that event will require a membership. And again, it can be a 30-day trial, and it's really one of our most popular events. So you might want to think about it. In addition, next week, Tuesday will be our Options Max Paying event, very popular. That also is a members only. So if you jump in as a trial member, you're going to get access to a lot of great information over the next couple of weeks. We've also got a special event you'll be hearing about coming up in a couple of weeks, where Tom's going to talk about what he sees happening for the rest of the year. We'll make sure everybody gets more information on that. Anyways, let me go ahead and make sure Mr. Bowley's in the house. How's it going, Tom?
Hey, John. Good afternoon, everybody. How you doing?
I'm doing pretty good. I woke up to a warning from NVIDIA and thinking, this could be a little trouble for the market. It started out positive, and then, of course, NVIDIA sort of put a little bit of kibosh on things. But even with that, you can just sense that. I can certainly sense the tone in the market where the bulls have really woken up here.
Yeah, I mean, there was a lot of signs, I guess, pointing to it. We saw a couple months ago, we started getting a lot more sentiment readings that made a lot more sense in terms of a market bottom, people growing a lot more fearful. That helps usually to spur prices back to the upside if we get some other signals as well. I mean, sentiment by itself can just signal short-term moves, but when you start seeing rotation like we've seen over the past 2, even 3 months, going back to the May bottom, we've seen money rotating into more aggressive areas of the market. That's Wall Street's signal that, hey, we feel like it's an all clear signal to jump back in to aggressive growth areas. And when I see that, I start turning much more bullish, and then throw the sentiment in and watch everyone essentially panicking and following the gaps to the downside. And then you start seeing a lot more accumulation throughout the trading day. I mean, there's just been this whole process. And that's what I talked about. Bottoming is a process. We can get signs of a bottom, but we need to see confirmation. We need to see these moves to the upside. We need to see that rotation continue. We need to see the sentiment line up, and everything has lined up. So yeah, I think the market's in a much, much better shape now. And there's still plenty of bears out there to fuel, a lot of them that don't believe in this rally. And I'll say this honestly, I think the best part, the easiest part of this resumption of the bull market has ended. I'm not saying that the bull market's ended, but this is the easy part where you get that big move to the upside. And if you're fortunate enough to catch it, this is where nobody believes. This is the NASDAQ, 18% rally from bottom to top, S&P 15% or whatever it was. Now we've got some issues, and now we've got a little bit of turbulence. We've got some overhead resistance. We've got sentiment that's becoming a little bit of a issue again, just in the short term. All these things I'll talk about as we go through. But yeah, I mean, I still think the market goes a lot higher from here, but it's going to take a little bit more work, and we may have to, deal with some consolidation, maybe even a pullback, which will really get the bears going again. But I don't think we're going back down to that June bottom. I really don't.
All right. Might as well just step to the side. Let you take it away.
All right. Well, why don't we go through the agenda? I'm going to try to go through this fairly quickly. Those of you who have been into these before know that they can drag on, because I like to give a lot of information. I like to talk to everybody about what I'm looking at when I'm putting together these portfolios, and whether you're an investor or a trader, I think there's a lot of good information in these events. We'll start off, obviously, with the introduction. Welcome, everyone. There, that part's done. Then we'll jump into just take a quick look at the current market and why I think maybe the short term, the easy money may have been made. And I'm not going to even say that for sure. I got a little question in my voice, because I've seen bottoms form, and I've seen the market rebound out of bottoms. And sometimes they go up so fast, they make your head spin. And we've seen a pretty good rally already. But we could just break out above this key resistance, just keep on going. And those who are just in denial, have to figure out what to do. I mean, it gets tougher and tougher as the market goes higher and higher if you're not in. So anyway, we'll see how all that plays out. So we'll take a quick look at the current market. Then we'll get into the 2022 results of the portfolios. And I'll talk a little bit more about results, maybe in a bigger picture next week when we actually do the draft. But I'll just go through what's transpired in 2022, because it's obviously been a very difficult market. Then I'm going to talk about upcoming changes, things that we're going to do differently in the portfolios going forward. I'm always, considering anything for the portfolios, always trying to figure out ways to help outperform the S&P 500, anything we can come up with. And so we do want to make a couple of changes. Then I'm going to get into themes, some of the things that I think are really important that we need to keep in mind as we make these selections and as we try to decide what types of stocks we want in our portfolios. You got to have a belief in something. You have to have a conviction. You think the market's going up, or you think the market's going down. I can tell you, if you think it's going up, you don't want the same stocks as if you think it's going down. So you've got to make some basic judgments about what you think the market's going to do. And then also what kind of an environment we're going to be in. Are rates going up? Are rates going down? Is the dollar going up? Is the dollar going down? Those things have impacts as to whether or not, you want to be into areas that are more aggressive or areas that are more defensive, growth or value. Interest rates play a big role in the valuation of growth stocks in particular. So that's an important component that we got to be thinking about. So we'll go through some of that. And then the selection process. I'll just talk a little bit about what we do. I really hoped to have the strong earnings chart list updated by this event, and it's not going to be updated probably until tomorrow, but we can still talk about some of the stocks and pull up charts, and I can give you a good sense of what we'll be looking at next week. All right, so let's go ahead and get this thing going. I'm going to jump in and talk a little bit first about a huge event that's coming up in a couple of weeks. We're just starting to announce it, but it's a free event. So those of you who are not members, you're certainly welcome to join us. It's going to be on August 27th. The only reason I'm bringing up our homepage is I just want to make sure if you're not already subscribed, you want to be subscribed to our EB Digest. This is anybody who's on this EB Digest newsletter will be invited to our event. It's going to be on Saturday, August 27th at 10 a.m. Eastern. And essentially, I'm going to be giving you my thoughts where I believe the market's going. I'll give you targets. I'll give you reasoning. We'll obviously go through a ton of charts. But if you want to be part of that, you need to be on this EB Digest newsletter, because this is the group we reach out to whenever we have free events. So it's not just the upcoming event. It's literally any event that we have that's free. We reach out to this community. So it's always a good thing to be a part of it. And also articles that are published come out 3 times a week. I try to make them very educational in nature. Sometimes they're great trading candidates for some of you, if you so choose. But anyway, make sure you go over to earningsbeats.com, scroll down, put in your name, email address, and hit that subscribe button if you haven't already. All right. So let's talk a little bit about today's action. When we broke down to the May low, we had this reaction high. The S&P 500 got up to 4176, and that was it. That was the high. Could not get through. We went back down to a new low. So we had this process, or not process, but we had this, lower low, lower high configuration on the chart that was continuing lower into mid-June. Now, price action, if you just follow price action, you look at it and you think nothing's changed. Well, I'm going to show you some things that have changed later when we start going through some of the themes, but a lot changed. First of all, you'll notice a lot more of this movement to the downside was gaps, number one. Number two, a lot of the selling that you saw on some of these days was very early in the morning. So you get the media headlines, you get the big selling at the open, selling for the first 30, 45 minutes, and then you start getting recovery. And we don't see much selling the rest of the day. And in fact, in the afternoons, things started to really turn. Look at all these hollow candlesticks that we've seen for the past 2 months. There's been so much accumulation taking place. Every time we have a little bit of a sell-off, look at all these red hollow candles. These are candles where we gap down and trade down intraday and then rally later in the day. I call the morning's amateur hour. Too many folks trading, chasing these gaps to the downside, thinking that they can short, everything's good, and the market reverses on them. And that's how bottoms form. One of the ways bottoms form. Anyhow, as we made this lower low, though, and then came back up, what you would have expected is maybe you get to the 50-day, maybe you get up to this prior low, and then you fail. So maybe you get the 3,900 and you fail. And it looked like that's what was going to happen, except the sustainability ratios that we follow were not going along with that. Sustainability ratios, none of them turned to a low that we saw back in June. None of them later went to a new low. And I've got basically about 6 of them that I follow pretty religiously. A couple of them are favorites of mine, but for the most part, I watch these 6 just to look to see the intermarket relationships. And all this was, in my opinion, was a head fake. Look at this low right here, intraday going below these lows. Looked like intraday, if you had looked at the chart probably at 10 or 10:30 in the morning, it would look like a breakdown. But if you wait until the close, it looks like a nice little kick save. And from there, we've been going straight up. Broke back up above this double top, pulled back, tested the moving averages, and then back off to the races again. This is a typical configuration coming out of a cyclical bear market. Now, there are going to be some of you that say, hey, this isn't cyclical, it's secular. You got to pick a side in the market. I'm not going to argue with you. If you believe this is a secular bull market or secular bear market, then I would be shorting heavily right now. I don't believe that's the case. And so it's just my opinion. I'm just one opinion in the market. Anyhow, this move up, I think today, if you're ever going to paint, or if I was ever going to paint a bearish picture, it would be today. I've been talking to members about negative divergences on the 60-minute charts and how that could signal a short-term top. Today, we had a breakout intraday. Remember down here, we're talking about this break potential, lower low, looked like we were rolling over and then we reversed. Well, here, it looked like we were breaking out this morning. And again, notice this morning, we were moving up, taking out this 4176. Actually, I think intraday had a high of 4177. Today, we got up to 4186. I mean, we were there. We were in breakout territory. And instead of breaking out, we reversed and closed at the low of the day. Here, this candle, we had a false breakdown and we reversed, finished at the high of the day. And then we had strength. If this market's going to pull back, here's the opportunity. I think tomorrow could be an ugly day. I just have this feeling. After that reversal, I don't like the market when I see that. When I see a false breakout, I wouldn't be surprised to see a big move down. Maybe even 100 points on the S&P wouldn't shock me. I don't mean to scare anybody, but I'm looking for a 20-day test. And I honestly think Wednesday, when the CPI comes out, I think folks are going to be shocked in the other direction. I think the headline news on the inflation is going to show a big drop. Maybe I'm wrong. I think Wednesday and especially Thursday. And the reason I'm saying headline, I don't know if it's going to happen at the core level. Headline, because the headline includes food and energy. I don't know if you've been watching energy. We were $123 a barrel back in mid-June. We are now $90 a barrel. Gas at the pump for the consumer, I don't know where it was in your area. Here in my area, it was probably at least 10, if not 15% higher than it is right now. I think we're going to come down. I think we're going to have some numbers that are going to be good or better than what we're expecting. We'll see. Anyway, that's Wednesday and Thursday. I always like to guess at these reports. We'll see. But in the meantime, I don't like that false breakout. And I think we could see a down day tomorrow. How much? I don't know. We'll see. If we can't hold these recent lows right in here, I think if we go back down below, into a new August low, which would take us down to about 40.70, 40.75, I think the next 1% could be really quick down to the 20-day. But we'll see. I don't want to get too far ahead of myself. Who knows? Maybe we gap up and just take off. That wouldn't, I'm bullish. So I'm licking my chops, hoping we get the pullback right now. Short term, I think things are just a little dicey, but longer term pullback. I'd love to see a pullback. I can promise you I will be buying on the 20-day test. So anyway, that's where I see the current market right now, just short term, more from a trading perspective. Longer term, if you're not all in, I would be all in. If you're somebody who doesn't like to trade, doesn't worry about the short term, the negative divergence on the hourly chart, and whether the market pulls back 2% today, but then goes up 3% later. If you don't want to deal with all that, you're just wondering, hey, should I be in the market, for 6 months from now or a year from now? My answer, and I'm not a registered investment advisor, so I can't give you advice, but my answer is I believe we're going to be higher, much higher, 6 months to or a year from now than we are right now. So I would just say, for my money, long term, I'd want to be long right now, even after this rally. Again, that's just my opinion. All right, let's talk a little bit about the results in 2022. And as I look at the S&P 500, what I've done is I got the S&P 500 up here, and I've gone back basically to, or what I have gone back to is November 19th. So the last 2 quarters. And the reason I went back to January 19th was that I wanted to go over, that was when we made changes to our portfolio, where it was the first change that we could make to our portfolio after the market had begun to break down. So back at the end of December, I was calling for market top. And at Market Vision 2022, for those of you that were there back on Saturday, January 8th, I made a case for 3,500 to 3,800 on the S&P 500. And I made a case for it to happen by June. I mean, it's recording. It was a recording. I'm sure many of you were probably there. From there, I projected, and again, this was all said back early January. From there, I said we'd reverse. And off of that June low, we'd come back up. And we might get back to where we started the year. But I thought by the end of the year or early 2023, we'd be back at all-time highs. I was looking for, in other words, a cyclical bear market, which is a 20% drop, but it's over a fairly short period of time, 3 to 6 months. We've had many of these over the years. We've had plenty of them within secular bull markets. So I was not looking for a major top for the long term. I was looking for a short-term 3 to 6 month cyclical bear market, and I think we've had it. So anyway, As of January 19th, this was the first opportunity because we go through and do our portfolio draft, what I like to call our draft, where we're drafting 10 stocks for each portfolio. We do it every 3 months. We do it on January 19th, or excuse me, we do it on February 19th. I actually did this as of January. I should have done February, the calculation. Anyway, January was when we did the draft for the ETF, the model ETF. February 19th is when we did the draft for the S&P. And unfortunately, I won't have those numbers because I didn't calculate. Let's just go as of January 19th. I'll have better numbers for the actual event next week. So the S&P 500 since January 19th, this would have been when we switched over on our model ETF portfolio. The S&P 500, and essentially it's about 119 trading days from January 19th to where we are now. And you can see that the S&P 500 during this period was down about 7.5%. Of course, we had a lot of drop back at the beginning of January. And then, of course, we've also come off the bottom quite a bit. So we were down 24% year to date back in mid-June. But I'm going from the January 19th date to where we are right now. And then we're down over roughly about 7.5%. The NASDAQ, so let me just scroll through here. NASDAQ, over the same period, is down about 10.5%. I'll pull up the large cap growth index, the Dow Jones US large cap growth index. And over the same period, it's down about 10%. The XLK, of course, that's technology sector, down about 8%. And the XLY down about 11% over that time period. Now, I'm going to give you some information on the couple of aggressive growth ETFs. And you probably followed them or heard of them. If you follow the ARK funds and Kathy Wood, who is the portfolio manager there. ARK. So if you were in growth, growth, and I showed you large cap growth, but I can tell you small cap, mid cap got hit even harder. And so this ARK Genomic Revolution multi-sector ETF, this one is down 18% since January 19th. The ARKK, which is the ARK Innovation ETF, over the same period, down 32.5%. The ARKW, down 35%. And then I also wanted to throw in here the FFTY, which is the IBD 50 fund. This is the Innovator IBD 50 fund. And over the same period, this is down 23%. Now, why am I showing you this? Well, since that same date, January 19th, our model portfolio has been down about 15%. So it's down probably twice the S&P 500's loss of about 7 or 8%. But it's way ahead of some of these other growth funds. And the reason I bring this up is that starting in February, when we did the February draft, that's when we got away from a lot of our growth stocks. We made adjustments, in other words. And so knowing what we knew and believing that we were in a bear market at that point, when I selected back November 19th, I was not thinking bear market. None of the signals had triggered for me at that point. So we went in to that next period with guns a-blazing as far as, being in growth stocks. And so we got hit pretty hard in that quarter leading up to February 19th, but it was February 19th that we made the adjustment. So we actually had this period, this month from January 19th to February 19th, where we were still in some of those growth stocks. But my point here is that we made adjustments to outperform other growth funds. It's really hard to outperform the S&P 500 during a cyclical bear market, especially one in which you almost had to have heavy representation in the energy group to outperform the S&P, and certainly to make money. You had to be in energy to a very, very large degree. And we try to balance the portfolios to some degree. We did have some energy names, but nothing, like we didn't have enough, certainly, to outperform the S&P 500. But we did outperform these other growth stocks. And I think, that's a point that I just want to take away from this. Our aggressive portfolio during this same period, since January 19th, our aggressive portfolio is down only 1.5%. That beats the S&P, it beats the NASDAQ, it beats all the, beats the XLK, the XLY, it beats the growth stock index, it beats all of those other growth stocks. The aggressive portfolio has been amazing since January 19th. So if we pull up the S&P 500, here was the 19th. We were up here somewhere around 4,600, maybe 4,500. Now here we are at 4,150. During this period, our aggressive portfolio has been down just 1.5%. I think in a down market, that's pretty incredible. And both our aggressive and our model portfolios since inception are both up twice as much as the S&P 500, or in the case of the model portfolio, actually even more. So I think over time, we've done pretty well with those two indices, or those two portfolios, I should say. But now I want to talk about some of the changes that we're going to make. Because, first of all, we've got 5 portfolios right now. We've got model, we've got aggressive, we've got income, we've got strong AD, which is strong accumulation distribution, based primarily on the AD line. That's our primary indicator for picking stocks in that particular portfolio. It worked great for a little while during the pandemic. And since then, I can just tell you it's not been good at all. We're going to eliminate the strong AD portfolio. I'm not doing that anymore going forward. Personally, I think what I've learned throughout the last year and a half is the AD line is a great secondary indicator. It's not a great primary indicator. So to use it to corroborate other things on the chart are great, but to pick a company and put it on a chart, put it in a portfolio strictly based on the strength of its AD line, in my opinion, is a mistake. And I think over time we're finding that out. So we're getting rid of that portfolio. I just don't like the results. And as a result, we're not going to draft stocks for that particular portfolio going forward. Another portfolio that we tested it for 1 quarter and then we added it last quarter, actually last 2 quarters, was the earnings reaction portfolio. Don't like the way that's going on either. That was based on how a company traded the day after its earnings report came out. So a company that the next day gapped up and then kept going higher, had a huge hollow candle, those types of companies were favored in the selection process. And over time, they just simply haven't worked. Part of this could just be the difficult market we've been in. I'm not going to lie. Looking back the last 2 or 3 years since the pandemic, the massive rotation that we've seen from one area to another, to another, to another, and then back to the original one. And it's just been this constant, very quick rotations. It's difficult because no one area seems to keep relative strength for a long period of time. So I think all of that is weighing on all of our portfolios. But the strong AD portfolio and the earnings reaction have just been so poor that I just don't think it's worthwhile to continue doing those. So we're getting rid of both of them. I am going to continue the income portfolio. It's lagged since inception, but I expect it to lag. It is, if you're buying, the income portfolio are going to be stocks that pay dividends. And for the most part, healthy dividends. Well, most of those stocks are going to be more value oriented. Not too many growth stocks pay out big dividends. Most value stocks do. They'll pay a higher percentage of their profits out in dividends. So if you're in a secular bull market, which I believe we're in, then it doesn't make a whole lot of sense to expect a dividend paying portfolio to outperform a growth oriented portfolio. So I would expect the income portfolio to underperform, but it, I think, provides a portfolio for members who are looking more in the way of dividends and don't care about the high flying stocks and don't care if they underperform a little bit. They want to make sure that they've got the income, you know, they're getting enough income. That's what the income portfolio will be designed, has been designed for, and will continue to be designed for. So we're going to have those three portfolios going forward: model, aggressive, and income. And the other thing, you know, for the most part, we have not had stocks in multiple portfolios. I'm eliminating that. If I like a stock and I want to put it in all three portfolios, then I'm going to do it. I think part of the problem with the portfolios and their performance over the last, you know, few quarters relative to the S&P 500, I think a lot of it is just we're getting so diversified. We have 5 portfolios now, and I've been trying to put 10 different stocks in each one. That's 50 stocks. It's hard to take 5 different sets of 10 stocks and have them all outperform the S&P 500. It's almost impossible. And that's what I think we're finding out, especially in this market environment. So we're going to cut back to 3. I'm thinking about adding a 4th one, and this one is going to be more trading oriented. I'm looking at it right now, but I'm thinking about taking a handful of stocks out of our 3 portfolios and trading them for 1 week. And then at the end of the week, pulling them out, putting in another 5. At the end of that week, we sell those, put in another 5. So basically what you're getting are weekly setups from our portfolios. And I'm interested, I'm doing a little bit of back testing right now on a couple of different strategies. And hopefully I'll be ready to announce that next week. All right. Anyway, so those are some of the changes that we are, not contemplating. Those are changes that are going to be made as we move into the next draft and the next quarter. So let's move on now to themes. And the first theme, well, the biggest theme, let me pull up this chart list for you 1 second. So this is the first theme I always talk about. And this is why I don't believe we're in a secular bear market. I believe we are in a secular bull market. I said it in 2016 when the market was trying to roll over. I said it in 2018 during the trade war. I said it in 2020 during the pandemic. And I said it before this one even began and throughout this cyclical bear market that we are in a secular bull market. We are in a period of time where U.S. equities outperform. It is a grand super cycle, and it's bullish. And don't believe me, look at the long-term 100-year chart of the S&P 500. We went through a long period, long secular bear market period. I've got, basically 20 years here highlighted. I think we started to come off the bottom in 1932, and I think we had a double top right here. We probably could have just looked at like 1937 to 1950, which would have been about 13 years as this secular bear market. If you look at the next ones, 1969 to 1981, 12 years, 2000 to 2013, 12, 13 years. These are cycles that the market goes through where for a long period of time, we basically never see a new high. 12, 13 years. Here, 12, 13 years. We had that one high in 1972, right before the big drop in 73, 74. And that was it. I mean, we didn't break out until 1980. And then we started the next secular bull. In 2000, we topped. 2007, double top. Wasn't until 2013 that we cleared the 2000 top. 13 years later. These are secular bear markets. So when you hear people talking about a secular bear market, if you believe that the high we just saw at the beginning of 2022 is going to be the highest level we see on the S&P 500 until 2034 or 2035, that, in my book, would be the equivalent of these other secular bear markets. I do not believe we're in that. I believe we are in a secular bull market, going higher, and you have cyclical bear markets within. We had one in 2020. We had one in 2018. We had a wannabe cyclical bear market back in 2015, 2016. We didn't get 20% lower, never hit 20%. So therefore, by definition, by somebody's definition, it was not a bear market. It was still a pretty bad market. During the last secular bull market, we had 1998, 20% drop. 1990, that was the Persian Gulf War, 20% drop. 1987 market crash. 1981, 82 cyclical bear market. We had 4 of them in this run. Go back to the 1950s. We had 1957 cyclical bear market. 1960 cyclical bear market. This one might have been close. Maybe it was, I think that one did go down 20%. 62, 66, all cyclical bear markets within a secular bull market. Long-term uptrend, short-term downtrends. Long-term uptrend, short-term downtrends. And that's what we're in now. Long-term uptrend, short-term downtrends. Hey, disagree with me. That's fine. I don't care. I'm just pointing out what I see and what I believe we're in. I think money is continuing to move into U.S. equities. Did we have a blip? Yes. And honestly, it was easy to see it coming. I wrote about it. I talked about it. I even projected where we were going back in early January 2022. Thought we would bottom in June, and I saw all the signs June 16th. Go look at the YouTube video. I'm not calling a bottom now. I called it June 16th. Yeah, I mean, those of you who are waiting to see us get to an all-time high, I mean, that's great to go back and say, well, yep, June was the low. What does that do for your portfolio? Anyway, I think the bottom is in. And until the market proves to me otherwise, I'm treating this as the resumption of a secular bull market. How everybody else wants to trade it, hey, it's a free world. You can do it however you want, whatever you believe. Other themes. So let's talk a little bit about this. Let's talk first about sector relative strength. So sector relative strength, technology, when I go to put these portfolios together, one of the first things I want to do is decide which sectors do I want to overweight. If I want to beat the S&P 500, the S&P 500 has about, 27% weighting in technology. 12% or whatever it is in consumer discretionary. X% in all these other sectors. So if I believe we're in a secular bull market and I think we're going higher, and I have 10 portfolio stocks and I put 2 of my 10 picks in technology, 20% of my portfolio is in technology. Well, the S&P's got 27%. I'm underweighting technology. If I want to outperform the S&P 500, I need to think about putting in 3 technology stocks, maybe 4 technology stocks. Depends on how bullish I am technology. Discretionary, I'm going to want at least 1, maybe 2 discretionary stocks so that I can overweight the areas I believe are going to be strong. Now, when I look at the XLK versus the S&P 500, this is a relative chart. If I wanted to look at the XLK, I would just pull up XLK. There's the XLK. This, what I was just looking at, is a relative chart. XLK divided by the S&P 500. So, for instance, here, the relative strength went down for a year from mid-2012 to mid-2013. If we look at the absolute chart, in the first half of 2013, we were setting a new high. Technology was breaking to a new high on an absolute chart. but it was underperforming the S&P. The S&P was going up faster. That's why this shows relative weakness. So if you were overweight in technology, it would have definitely been harder to outperform the S&P because you're invested in stocks in a group that's underperforming the S&P. Now, here's what I look for on this longer term relative chart. This is a weekly chart. If you go back, or at least if I go back and I look at every time the weekly PPO is below zero or at zero and turns back up and crosses its trigger line. Here's the PPO going down. That red line that you see, the thin red line, that's the 9 period, or in this case, 9-week moving average of the PPO. When we start to turn back up and we cross over that 9-week moving average, if I put that on every one of these charts, or every time we get that crossover, either at the center line or below, I want you to look at how many times this happens. This is the 5th time since this secular bull market began. Remember when I said we broke out in 2013 above the 2000 high? That was about 10 years ago, 9 years and 5 months or whatever, 9 years and 4 months, almost a decade ago. When we broke here, we had a little bit more relative weakness, but then you can see this took off. When we made this crossover here, we never went back down to that low. Technology led. We made this crossover right here, technology explodes. Made this crossover, technology explodes. Make this crossover, here we go with technology again. I can promise you, I'm going to be looking for solid technology companies in our portfolios next week. I believe technology is going to be outperforming. I think we're going higher. I think we're in a secular bull market. I think we're resuming it now that the cyclical bear market is over, and I'm going to want to be aggressive. And if that turns out to be the wrong position, well, I had conviction. And members can use stops if they want. We hold our positions for 90 days. Next up, discretionary. I mean, we can do basically the same thing with discretionary. These are the 2 groups, by the way, or 2 of the 3 groups that tend to lead secular bull market rallies. So if I do the same thing here, we had that crossover. We kind of had a little false, little hiccup there, but there was basically a second move there. Had a little churning in here, and you can see that led to a little weakness, but I would say the first signal would have been right about there. We saw some strength, but then we ended up moving back down. Here, that was a great signal. Here, that's after we test the center line, turn back up. And from here, actually, we went down for a couple months, but then did later go to new highs. Here, that was a little bit of a false move for sure, but this one was a great signal. Coming down here, that was a pretty strong signal. And then here. And we now have discretionary moving back up again. So this one wasn't quite as strong, I would say, as technology, but still, based on what I'm seeing and looking at this chart, I'm going to want to make sure I have nice representation in discretionary. All right. Let's look at, I want to look at the S&P 500 versus what I call sustainability ratios. So here's the S&P going down from January through June. Lower low, lower low, lower low, lower low. Here are my sustainability ratios. This is XLY, XLP. Lower low, lower low, lower low. We didn't sustain. We're not showing signs of sustaining that move to the downside as we hit the June low. Look at the QQQ versus the SPY. NASDAQ 100 versus the S&P 500. Came down, lower low, lower low, lower low. June, turned back up again. This is large cap growth versus value, IWF versus IWD. Lower low, lower low, lower low. June didn't go down to a new low. Another large cap growth versus large cap value ratios right here. Lower low, lower low, lower low. Turn back up for June. Mid cap growth versus mid cap value. Lower low all the way down. June turned back up. Small cap growth versus small cap value. Lower low, lower low, lower low. June turning back up again. So the S&P was going to new lows. Everybody's getting more fearful, but Wall Street is rotating into aggressive areas. At the top, as we put in the final high, Wall Street was doing the opposite. Wall Street was getting out of the aggressive areas, basically saying, okay, retail investors, you all hold the bag for all of these growth stocks. We're getting out. We're moving to more defensive positions. Good luck and have fun. That's essentially what Wall Street was saying to everybody at the beginning of January. In June, while everybody's panicking, believing that this is going to be the next Great Depression 2.0, Wall Street is calmly moving into all these growth areas while everyone else is panicking out. They're gladly building these positions and moving higher. So you be the judge. Maybe it doesn't matter to you. That's fine. I happen to think this is a pretty important signal. And that's why back in June, when we hit this low, and we also got the sentiment reading at the same time that I'd been waiting for, I was like, this is it. This is the bottom. And if it wasn't the bottom, I said at the time I could live with it. The market was telling me to change my tune, to change my strategy. CNBC wasn't telling me that. CNBC was, bringing on Peter Schiff, all the big bears talking about how bad this is going to get. Whatever. Stock market has had 3 really bad secular bear markets since 1950. 3 of them. If you want to believe that this is the start of the 4th one, go ahead. We've had 3 in 72 years. We went down 25%. It was the 6th worst cyclical bear market since 1950. How much more do you want to price in? Anyway. All right. So those were some of the themes. Now, sentiment also is one thing I wanted to point out. This is the 5-day moving average. Look at where we were on the 5-day moving average of the equity only put call ratio back in November of last year, 0.39. That means that equity only put call ratio, your numerator are puts and your denominator are calls. So puts being bought versus calls, 0.39. So for every 39 puts, there were 100 calls on average over a 5-day period. Now, let me go back and show you the last 15 years of this. And let me just show you that when we're down at 0.39 and you look at the last 15 years, we don't get this bullish much. And it wasn't just about that one 5-day reading. Look at this cluster right here for a year, leading up really to the end of 2021. Look at how much lower the equity only put call readings were, the 5-day moving average. Look at it where it was relative to any other point in the last 15 years. Nowhere even close. We had a few readings down here under 0.5. Here's your 0.5 level right here. Here we had one little cluster in 2014. Here we had a couple. We almost lived below 0.50 for 18 months. These are all your Wall Street bets, Reddit folks, believing the market couldn't go anywhere but up. 18 months of that. The market over a 22-month period, the S&P 500 climbed more than it had ever climbed, at least since 1950. Going into that, so to start the year, we had that. Then we had Wall Street rotating out of aggressive areas and into defensive areas as the S&P was setting its last high. And I looked at that and I'm just like, do we really want to risk our capital going into 2022? And my answer was no, I really don't. It wasn't about being right or wrong at the time. And I always say that. I don't care whether I'm right or wrong. When I'm looking at charts and it's telling me that the risk is way too high to be invested on the long side, I get out. And likewise, when I get a signal up here where every major bottom this century has occurred with an equity only a 5-day reading above 0.75. And all but 3 of them have gotten to 0.80. So I wanted to get to 0.80. That was one of my goals of resetting sentiment. When did we go above 0.80? June 16th. I'm not making any of this up. It's right there. There it was. I talked about it in real time. When everybody bets against the market, or when everybody's betting on the market, you've got to be at least considering a possible top or bottom. Now, I will tell you that the market reacts to fear much more strongly than it does to complacency. In other words, I've seen, we saw those readings on the put call down here for a long time and the market never topped. I've seen complacency last for a long time. Fear, where you're ready to, we got traders running around with their hair on fire. That doesn't happen very often. And when it does, it tends to be a swift move down in the market, capitulation, and done. Now, some people say, well, we haven't had capitulation. I would argue with that. I mean, if you're looking back at the S&P 500 at this low, did we have anything that was off the charts? Well, this was a pretty big off the chart volume day, when the day we hit the low. But falling from almost 4,200 down to 3636, what is that? 560 points in a matter of about 7 or 8 trading days. Does that not mean anything? Also, if you followed the intraday trading, when you start looking at all these gaps, that's when I know we're being manipulated to the downside. Huge gaps and then reversals. And then on the way back up, we had many gaps down and reversed back to the upside. So anyway, there's a lot going on there. But my point here is when you're looking at sentiment and you get that reading right there, anytime you get that reading, and I've had questions come up from members, and they're like, what about, back in the year 2008, we got up to 1 on the 5-day moving average. Shouldn't we be waiting for that? Well, first of all, extreme fear like that only comes along so often. If you think about it, 2007 was already very bearish. So fear was already elevated. So we're coming off of elevated levels to set that high. Here, we're not coming off of any kind of elevated levels. 0.8 reading relative to what we were seeing is extreme if you follow, the market. I mean, when we came off of this low, here was the extreme. We got up to 0.80. This one was a little bit higher. We started a little bit higher, and we ended up topping out a little bit over 0.90. This one, 0.90. This one, 0.8, 0.85, 0.9. My point was just get me to 8.8. I knew that every bottom Every major bottom this century had at least a 0.75 reading. And of the 17 major bottoms that I counted, 14 of them got to 0.80. So that's what I was looking for. That happened to coincide right when Wall Street's moving into aggressive areas of the market. You know, look at your 50-day moving average. Look at your 200-day moving average. I don't care. I'm looking at what Wall Street's doing. I'm looking at the panic, the level of panic that marks bottoms. That's what I'm looking at. So these are the themes. One last theme I would mention is the 10-year Treasury yield. This is going to be a 5-day moving average. Forget about that. Let's go over here. I see a topping head and shoulder structure. Left shoulder, neckline, head, neckline, right shoulder breakdown. I'm looking for yields to fall into the end of the year. And as inflation begins to become more and more benign, why would the Fed raise? The Fed doesn't raise just because the economy is strong, and the economy hasn't really been strong. GDP negative 2 times in a row. But I saw somebody post something about, well, the jobs report was strong, therefore the Fed's going to raise rates. The Fed doesn't raise rates just because jobs reports are strong. They raise rates to keep inflation in check. If inflation's coming down and jobs are strong, they are not going to raise rates. In my opinion, just my opinion. So I personally think all the rate hikes are done. Maybe there's one in September. I think we'll have to see what happens. But if I'm right and the yields are coming down and we get a couple of tame CPI reports, I do not see the Fed raising rates again. If they do, it's going to be one of the biggest mistakes they make. I don't put too much past Jay Powell because I don't think he's been as good a Fed chair as we've seen in the past with Yellen and Bernanke and all of the prior Fed chiefs. I think have done much better job, in my opinion. I think Powell waits too long. I don't think sometimes he talks way tougher than he should. I think he's caused stock market problems before the 2018 trade war. I don't think we ever had to see a drop as much as we had back then if he hadn't come out and started talking about interest rates, that they were going to raise rates. They never did. He talked about it and the markets got spooked. So I don't really trust a whole lot of what the current Fed chief says. Not a big fan. But eventually they'll get it right. It's just how much pain do we have to go through, until they can fix their mistakes. Anyway, so that's the 10-year Treasury yield. I see it coming down, and that's going to help valuations of growth stocks, which fits right into why Wall Street's pouring in to technology and consumer discretionary right now. I mean, the market and all the intermarket stuff, if you look at it, it all makes sense. But CNBC doesn't talk about any of that stuff. How are they going to get anybody to click on their stupid articles if they talk about the fact that the market's looking more bullish? John texted me earlier today and said that CNBC was talking about or asking analysts, if the June bottom was the bottom. Well, now we're 15% higher. And there's still a lot of analysts saying, no, we got to go back down. Good luck. What are you going to say when it's up 25%, 30%? When are they going to come back and apologize and say, oh, you know what? That was really dumb. They won't do that. And you know what? CNBC will invite them back. Come on back. You were so bad last time. We'd like to get you back on again. All right. End the rant. All right. So the selection process, what do we do? Well, the first thing we do is we go through and we look through the strong earnings chart list. My background, I'm a former practicing CPA. I was in public accounting for 20 years. I was a principal in one of the largest CPA firms in the Washington, D.C., Baltimore, Maryland metropolitan area, that whole area. I audited banks. I audited manufacturers. I audited retailers. I audited country clubs. That was fun. I audited some nonprofits. But my point is, I understand the fundamentals. That's my background. So one unique thing I think about our service is I think we do a really good job on the technical side, and I'm always studying the market, always. When I'm talking always, I'm saying pretty much always, just about every 7 days a week. I go to Starbucks every day and I've got my computers with me. I'm looking at the stock market all the time. I've studied it. I've researched it. I've analyzed it. I've, taken my spreadsheets, turned them upside down, spun them around, trying to come up with any advantage I can in the stock market. So we combine our fundamentals, our technicals, our historical approach, and we come up with what we believe are the best trades, the best portfolios. That's how we do everything we do. So one of the things that we do at Earnings Beats is we have a research platform that includes many chart lists. I use the stock charts platform, and I save and organize my work at stock charts. So it only makes sense that we suggest, obviously our members can do whatever they want to do, but we always suggest that our members at least try the platform. And I understand if you're using another charting platform, that's not easy, to make big changes. And we're trying to work as best we can with folks who don't have stock charts, that platform as their go-to. But if you do, the work we do, literally, I just drop into your account and you can save it right into your, as a chart list into your account. So one of the things we do is a strong earnings chart list. So I pour through, and the last several days, I can't even begin to tell you how many earnings reports, revenues, earnings I've looked at. I'm going to say probably 3,000 in the last 5 days, maybe. And I'm looking at all those charts, the companies that beat top and bottom line, and also their charts look good and they have enough volume so that they're liquid. They are entered into this strong earnings chart list. We keep it chronological order. So when I edit it, for instance, here was the one from longest to go, ANET, but the one that was the last one was RRC. Now, this would have been probably as of a couple of weeks ago. I am literally tomorrow looking to update this for all of our members so that you'll be able to either view this chart list, or if you're a member at Stock Charts, you can download it. Even if you're not a member at Stock Charts, you can still view the charts. You're just not going to be able to download it into your account because you don't have a Stock Charts account. Anyway, what I'm going to be doing as we go into the selection process next week is I'm going to be looking for stocks that I believe are just trading, exceptionally. They've come out with great news. They're trading well, strong versus their industry group. They've got great relative strength. They are probably stocks that appear to have or appear to be are being accumulated. So usually strong AD lines add to the bullishness. I would look at a stock like Cadence Design, for instance. I love the fact that we went down to sideways consolidation. We break out AD line straight up, new highs, and look at Cadence Design relative to software. It's one of the best performing software stocks. Now, software looks like it bottomed back in May and has been trending higher, and it's just at about a 4-month relative high. If between now and next week, software makes a relative breakout, I'm going to want to make sure that I've got software stocks in at least one of the portfolios, if not all of the portfolios. And so a stock like Cadence Design is one that I would absolutely consider because it's showing relative strength. Wall Street likes it. If Wall Street likes it, I like it until Wall Street tells me I don't like it anymore. And so that's what I would be looking for. Now, if it happens to be next Thursday and we're drafting and the chart looks like this, we're going to get in at wherever the stock closes next Friday. Members can do whatever they want. You can ignore the portfolios. You can trade the portfolios. You can look at a stock like this and say, well, it looks like it's a little overbought. You might look up here and say, I see a negative divergence. I don't see one here, but you could say, hey, it's got a negative divergence. I'm going to wait. That's perfect. It's fine. Members, you should be doing anything you want to do. Again, I'm not a registered investment advisor. I'm not telling anyone to buy stocks at any price. I'm just saying from an educational perspective, we keep these portfolios as a means to show our members how you can outperform the S&P 500. And if we don't outperform the S&P 500, then we're going to try to tweak things until we do. That's the goal. Because if we can't outperform the S&P, then whenever we get a bullish signal, just buy the spider. Forget about individual stocks, right? Why would we care? So if you're going to do portfolios, you want to make sure you're outperforming the S&P 500. Now, I would say you want to do it over time. And time, I guess, depends on each person. Some folks come in here and they see our portfolios have a bad quarter and that's it. Well, if you changed portfolio managers every time they had an underperforming quarter, you'd probably change just about every quarter because most portfolio managers underperform. I think our longer term track record, though, has been pretty solid. So anyway, that's one stock, Cadence Design. Now, if we had, let me see if there's another one on here that I recognize that maybe had a good report. NDAQ I thought was pretty strong. Here was where they broke out. Pretty good volume. Look at the AD line. Look at the relative strength, setting a new 52-week high. But again, here's another group. Is investment services going to move to a new 4 or 5 month relative high? That would help. That would lean me more toward a group like that. If I see the industry group is outperforming, then I would look for stocks that are strong within the group. And that could lead me to a stock like NDAQ, NASDAQ, OMX group. So anyway, that's essentially what I have. And that's how we're going to put these things together. I'm looking forward to it, especially looking forward to possibly doing like a trading portfolio we might have the model portfolio and there might be a model trading portfolio. We've had members who, and probably the most confusing part of our service, and I hate it that it's confusing. I don't want our service to be confusing, but I'll have members who will, write in or will ask questions about, if you believe the stock market was going down back on December 31st, why are you investing in the portfolios? That's probably the single most, the most questions that we get probably along those lines. And you have to understand that we have a service that appeals to traders. We have a service that appeals to those who don't want to trade, don't want to be active in the market, don't want to try to time the market with, we're in a bear market. We're in a bull market. We're pulling back. We're off the 20-day. Now it's good to get back in. They're working jobs. They can do this once a quarter. They don't want to do it once a week. They don't want to do it twice during the week. They don't want to think one thing at 10 a.m. and at 2 o'clock, pull everything back out. They don't have time for it. So what we do with traders at Earnings Beats and what we do with our folks who are more interested in the big picture, the longer term, that's where we go from having a service that provides guidance, which may predict a bear market from time to time, versus portfolios, which are fully invested 100% of the time. Think about it. If somebody says buy and hold, said, listen, I'm a buy and holder, would you ask them, well, when do you get out of the market? I think they would say, I'm a buy and holder. I don't get out of the market. I buy and I hold. So the whole idea behind these portfolios originally was to go back to members who were writing in and saying, you know what, I love your relative strength work. I love, all of your education, but I work during the day. I don't have time to be looking at this even weekly. I don't have time. I don't want to deal with it like that. What can you do for somebody like me? And that's when the portfolios were born. The model portfolio was born back in the fourth quarter, November of 2018. right in the middle of a trade war, by the way. And the market, that was a cyclical bear market. We started the portfolio. We've had a cyclical bear market in 2018, the pandemic in 2020, and another cyclical bear market in 2022. All this crazy rotation, and through it all, our model portfolio has outperformed the S&P 500 more than double. I mean, I think something's working. Now, has it been tough the last year? Yeah, it's been really tough with inflation fears, then recession fears. You got the pandemic, you got all these things, you got the war going on. I mean, obviously there's a lot going on, or we wouldn't be down, or we wouldn't have gone down 25%. But I do think we've done a pretty good job in maneuvering our portfolios. When we thought the bear market was in play back in February, we didn't put in a whole lot of growth stocks. We sprinkled in a couple just in case. And that's why we underperformed the S&P. If we had just gone completely against all growth stocks and put more energy in, we probably would have beaten the S&P 500. Maybe we would have even made money. I don't know. We didn't go that far, but we did outperform ARK funds. We did outperform the Innovator 50, that IBD fund. And we did it because we adjusted on the fly, but we did it only quarterly. Not every day, not every week, not trying to catch the tops and the bottoms of the bear market. It was done in a much more buy and hold kind of method. And I've had members say, well, it's not buy and hold. You switch out every quarter. Well, that's kind of how, that's the combination. That's the middle ground. I'm never going to be buy and hold. If you're looking for somebody that tells you to buy a stock and hold it for 50 years, I'm not the right person. I mean, if you want to buy the spider and hold it 50 years, I think you'll do great. Do it. But you're going to hit a secular bear market at some point in time, and it's not going to be pretty. It's not going to be fun. You're going to lose a lot of whatever you've built up. And as you start getting closer to your retirement and your 401k is coming down because you're in a secular bear market, you're going to start to panic. You might think you're buy and hold. A lot of buy and hold people are only buy and hold as long as the market goes up. Market goes down, they're not buy and hold anymore. They want to get the heck out. So anyway, I think the portfolio is changing every 90 days. Makes sense. And we're going to do this next week. So make sure you have that on your calendar. You do need to be a member, though. You need to be at least a trial member at Earnings Beats. So take out a 30-day trial. This is a great time to do it. Make sure you got a seat for next Thursday's top 10 draft of all of our portfolios. So that's essentially what I have, John. I don't know. Do we have some questions?
Got a couple questions. One is, what would change your mind that the market looks like it would be breaking down?
Well, the things that made me think the market is going up in the first place. So I would be looking at pull up the chart. I mean, the one big one is going to be my sustainability ratios. I mean, if the market rolls back over and the sustainability ratios keep putting in higher highs, I'm not going to be thinking we're going back down to new lows. Why would Wall Street move into technology and discretionary and growth stocks versus value if Wall Street believed we were going to go down for another 6 months or a year? There's no earthly reason why we would do that. So let me pull up these ratios again and just show you. So right now we're going up and so are the ratios. So if we were to go back down, first of all, I think a 20-day test would be normal. I believe we're in a secular bull market rally. PPO looks great. A normal pullback tests the 20-day. So pulling back down to the 20-day is not going to bother me at all. I will not think anything of that. And when we pull back, I wouldn't be surprised to see the ratios pull back a little bit. We're already seeing a little bit of that as we tried to break out to a new high. You can see the QQQ underperforming a little bit. XLY, XLP pulled back a little. Growth starting to pull back a little. We could be, I mean, this could be the early stages of a little pullback to the 20-day. But what I would look for, bigger picture, is when this starts to roll over, first of all, it can't get back down to the new low without breaking down below the moving averages. So that would be the first thing that would have to happen. And then my ratios would really have to start rolling back over in a big way. And if I saw that, yeah, I would start to grow much more concerned, because at that point, Wall Street's telling me, hey, we might have some problems ahead. But I can also say that I said to get in here. If it breaks down, you can always decide if you want to put in your stop loss. But now that we're up, I mean, S&P 500 probably up 14, 15% off the low. QQQ 17, 18% off the low. If we were to pull back and give back half of those gains, I still made money off the bottom. I mean, I'm not panicking. I'm not going to worry about it. I would say at this point, 3,900, I don't believe we go below 3,900 on the S&P 500. If we go below 3,900 and we start seeing everything tumbling back down in these ratios, then I would certainly be willing to consider that we've got further to go in this market. But don't ask me while we're going up and with these sustainability ratios going up, if I think we're going to go back down. No, I do not. I don't think that's the case.
All right. I probably could have answered this one, but I'll give it to you. Nice talk. Are you 100% invested in your retirement account? Or if what are the major holdings?
I actually moved out of a lot of stuff, only not long-term, only to see if we could get through this level. So when we started moving up, especially when we broke out above 3,900, I kept saying I thought the S&P would go to this 4176 level. I see what could be a bottoming head and shoulder pattern, reverse, which is a bullish pattern. But if it forms, we potentially could have a right shoulder. Now, keep in mind, I like to trade. If you were asking me right now, would I sell because I think we're going lower, or would I hold because I think we're going higher? I would hold. I believe further down the road, end of this year, next year, we're higher, I would be in. So I would have no problem holding. But again, I'm a trader. I just want to make sure everyone understands that. If I was long and I was in leveraged ETFs for much of this move to the upside, I was very aggressive. But as you start to make moves and you get further and further away from moving averages, I don't believe it's good to be in leveraged ETFs at all. So probably a week and a half, 2 weeks ago, I don't even remember when, I got out of all my leveraged ETFs well before we got to the top. Because as far as I was concerned, we had just as much chance going down testing the 20 as we did going up and getting to this 4176 level. So for me, it's about evaluating risk and just realizing that, hey, I've been in, I've had a nice run to the upside. Let's see if we get through 4176 on this move. And if I've built cash up and we pull back and hit that rising 20-day, I will be back in to the QLD personally. I will trade much more aggressively because that's where I believe we're going to turn again. I would love an intraday move below the 20 and a close back above it. So anyway, I hope that helps.
Okay, we can wrap it up. I'm not quite sure I fully understand the question, but maybe it pertains to the portfolios. Could you describe the qualifications for earnings beats chart list? Is it on a quarter over quarter improvement, year over year, or other criteria? And we have so many different chart lists.
I think probably because I was talking about the strong earnings chart list, I'm guessing that it has to do with the earnings and whether it's year over year, whether it's quarter by quarter. Okay. So to answer that question, it's quarter by quarter. So in other words, I'm looking at updating this chart list every quarter based on the last quarter that they just reported. And they will stay on the chart list until they get ready to report the next quarter. I pull them off and then I go through and rinse and repeat. Look to see if they beat their earnings, they beat their revenue, look at their chart. If I like everything, they go right back on again after earnings. So no stock in theory should stay on there through earnings. Now, sometimes I don't update our chart list for a week or two. Like we've had so many earnings come in the last 2 weeks. I've been inundated trying to get this updated. I've done everything except annotate the charts. I've got to do that tomorrow. And then I should be good to go and we'll send that out. But there's probably some stocks right now on the strong earnings chart list that have just reported because they've just reported again. I'll be pulling those off And if they reported strong, then I'll be putting them right back on again. So hopefully that helps. But I'm only looking fundamentally to see if see if management teams were able to beat those Wall Street consensus estimates. If they have, I think it's a big feather in their cap with Wall Street. I believe Wall Street is much more likely to bid up the shares of a company that has beaten estimates than a company that has missed estimates. I mean, if you come up to me and you say, hey, I said we were going to get to 25 cents this quarter. We only got to 17 cents, but don't worry, because next quarter we're going to do 35 cents. And I'm thinking, well, you couldn't meet it this quarter. Why do I want to believe you're going to do it next quarter? I think that there is a credibility factor when Wall Street evaluates companies to include them in their portfolios. And when they get to a point where they can't trust management teams, I think it takes a while to get that back. That's the whole reason why we have a strong earnings chart list. These are companies, every single one of them in their last quarter beat Wall Street estimates. They may have lowered guidance. I don't care. I would rather have a management team lower guidance and then beat that guidance next quarter than to raise guidance and miss. That hopefully that makes common sense. But anyway, I'd rather have a conservative team. Apple's management team has always been very conservative. They're almost always blowing out expectations, almost always, not always. And it's because they tend to be very conservative with Wall Street, telling them the bare minimum of what they're doing, and then they always come through. And to me, if I was, Wall Street firm, those are the kinds of companies I would gravitate to.
No, let's get this one last one in, then you can close it up. Kind of an interesting question. Looking at the SPX, the March 14th low could have looked at the time like it was also the bottom. Why is it different now?
A couple things. Number one, look at the last low. Lower low, lower low, lower low, lower low on the ratios. Lower low, lower low, lower low, lower low, lower low, lower low. Every one of these ratios is telling me that Wall Street is continuing at these lows to have gotten out of the market. That's point number one, or to have rotated out of those aggressive areas. Point number two, and John, you can back me up on this, and all members that have been members of Earnings Beats can back me up on this. Back in mid-March on the 14th, we did our Max Payne webinar, and we had the most in-the-money put premium that I have ever seen. Because of this huge move down, we were at the low on March 14th. And so there were almost no in-the-money calls, and almost everything was in-the-money puts. We had, I want to say, $10 billion worth of net in-the-money put premium on just the QQQ and the SPY, just those two ETFs. Normally, most months, it's not even 1 billion. It was 10 billion. And so at that Max Payne, I talked to folks. I said, we could have a massive rally here. And look what happened the next 4 days, right up until option expiration Friday. Now, we did go back up a little bit further, but much of that gain, in my opinion, was lining Wall Street firms' pockets. There's tons of manipulation in the stock market. Over time, stock prices go where they need to go. And that's why we ended up going back down. In the short term, however, Max Payne, the third Friday of every month, there can be a lot of manipulation around that. And you want to be very, very careful. Another reason to sign up for a 30-day trial is we got our next Max Payne event coming up next week. And I'll tell you what, if the market keeps going up, it's going to have something to deal with potentially to the downside, because there'll probably be a lot of in-the-money calls and not nearly as many in-the-money puts. So that was the second thing. So number one, Wall Street at the prior low was still betting against the market. It was still moving into defensive areas. That's why I didn't trust this rally. This rally is coming after Wall Street has already begun to rotate. That's a major difference between this rally and that rally. The other thing I would say, sentiment was not high enough back then. We had not been bearish enough. None of these prior readings had our equity only put call ratio anywhere near where it needed to go. So if I look back at, I don't know where I had that chart now. Let me go back over here. I can pull it up real quick. So if you want to know how to set this equity only put call ratio, type it in, and then down here, instead of candlesticks, go down and choose invisible. Now, if you click on it, all it's going to show are the overlays. It's not going to show you the reading every day. Why? Because that's invisible. Now, the only moving average I want is the 5-day simple moving average. So I'll get rid of the EMA. I don't need all this other stuff. I don't need the AD line. I don't need the PPO. I don't need volume. So when I'm looking at this, normally all I'm doing is I'm looking at the CPC 5-day moving average, and then I'll look at, sometimes I'll pull up the S&P 500. So I wanted to see 0.80. June, we got the 0.80. I feel like sentiment's been reset. Where were we March 14th bottom? 0.62, 0.63. I mean, January, honestly, showed more reaction, a little bit more bearishness then. March, we still hadn't suffered enough. There wasn't enough pain. And look at how fast, how rapidly on that March rally, how quickly we went right back down to 0.45. All those Reddit folks thought, that's it. We're done. We're going back up to all-time highs. Our little 2-month fiasco to the downside's over. And then what'd the market do? Pulled the carpet right out from under them. So those are all reasons why, in my opinion, this is much different. This right here is much different than it was back in March. So that's all I got for that. Any other questions, John, or is that it?
That's it.
Okay, we're going to go ahead and wrap up. I appreciate everybody coming in. Again, the real deal is next Thursday. We're going to pick all the stocks for our portfolios, going to make some changes, as I talked about earlier. And I'm excited. I'm excited because I do believe we have bottomed. I think we're going higher, and I'm ready to see this market really explode. Right now, August, September historically can be a little challenging. We just hit this high I talked about. That can maybe cause us to pause a little bit. But I'm telling you, I'm so excited about the fourth quarter of this year based on everything I'm seeing. I almost just want to skip over August and September and just go right on into October. But we won't do that. Anyhow, hope everybody had a great time here, learned a couple of things, and hope to see you next Thursday. If you're not a member, make sure you join up, hit that, or start up your 30-day free trial. Anyway, everybody have a great evening. I'll be back tomorrow for my Trading Places show. Take care, everybody. Happy trading.